Good morning, everybody. This is the live market open for Thursday, January 28th. I'm Yohay Elam of Forex Crunch and Market Movers podcast. I hope you can see the video. If not, please refresh the screen. I hope we don't have technical problems. Anyway, as usual, we'll cover recent developments, charts and levels, the next 24 hours, talk about the Fed, of course, and answer your questions. If you cannot see the chat box, please go to the address on the screen, tlk.io/fxread-forex-live-video. Okay, I hope you can see the video and participate in the chat. We just began. What was the main event yesterday? No prizes for guessing that. It was the Federal Reserve. The Fed decision was slightly dovish. What did they say in the statement? Of course, they didn't change policy. We didn't expect them to. What they did do is that they mentioned that growth has slowed down in late 2015. I think that's a hint for the GDP report we have tomorrow at 1:30 GMT, because the Fed probably had the figures before their eyes, okay? What else did they say? They still mentioned, they put an emphasis on inflation, still a big worry. Okay, that's not new from last time. We know that their inflation expectations surveys are still okay, but the actual inflation figures for them, especially the core PCE price index, is stubborn at 1.3. The core CPI, which is the more classic figure, is, well, that's okay, that's 2.1. Anyway, another thing that sort of stood out, good morning everybody, is that they removed the reference to balanced risks. So there was a lot of commotion about that. What does it mean? Are they not seeing risks as balanced? Are they worried? Or was it just a semantic change? I think there was a little bit too much noise about that. There were other things that were clear, okay? Like that they're monitoring global and financial developments, worried about China, worried about stock markets, of course. And another another dovish thing that I saw here was that despite the new composition of the Federal Reserve, we have new hawks over there, like Esther George of the Kansas Fed. The decision was unanimous, okay? 10 out of 10 voted for the statement, which was leaning to the dovish side, slower growth, worried about inflation, monitoring global and financial developments, no change, of course, in policy, no new rate hike after that December rate hike. So let's look at what we had in financial markets. In currencies, of course, we have euro dollar right here. Sorry, that's dollar yen. Euro dollar basically stable. So we had a bit of movement around the Fed, but it was one of the more, unfortunately, boring reactions I've ever seen to a Fed decision. I was on air with Valeria Bidnarek, Dale Pinkard, and Mauricio Carrillo, and we were looking for big moves. We didn't see too much of that. We did see some kind of a risk-off reaction. I remember one of the scenarios I described yesterday talked about the chance that we'll have a confusion in markets and then we'll have risk-off. So it did play out for some time. We had, at the beginning, no reaction at all. Very boring stuff. And then we had a bit of a sort of stronger euro, stronger yen, and weaker commodity currencies, but we never went too far, okay? So we reached 109.15 in euro dollar, and now we're back to the range 108.78, and today's range in euro dollar is just under 40 pips, okay? So yeah, I'm a bit frustrated. Euro dollar remains a frustrating pair. I know lots of you are trading this one, but there are other pairs as well. Hopefully today we'll have more action from there, okay? Dollar yen, we had dollar yen falling just a bit, but also here we never went too far. Now we're back up again, 118.76, 118.90 some. The lines here are not that strong. Perhaps the new high just above, perhaps the round number of 119 works as resistance. We'll have more action from the yen overnight because we have a rate decision. We'll talk about that more in detail soon. The pound, which is suffers from misery, it also suffered a bit yesterday, but now it's recovering. All in all, 142.53 resistance over there, this double top. 143.65. Real support at 141.25 and then 140.80. What we've seen yesterday before the Fed is strengthening of oil. I'm talking about oil because it's a prelude to talking about the Canadian dollar. Currently, again, a bit higher, 32.20, sort of trying to reach higher ground. Yesterday, we had news that Russia is considering cooperation with OPEC on cutting oil production. That could be significant because Russia has a huge production. OPEC is only a third of global production, with Saudi Arabia basically controlling the team. The others are not willing to cut. If we have Russia and Saudi Arabia cooperating and cutting production, it could be significant. But they would sort of give a prize to shale in the industry in the United States, and these countries are also on opposing sides in the Syrian civil war. Russia supports the Assad regime, and Saudi Arabia is against. Anyway, we've seen the rise in oil prices, and that supported the Canadian dollar. But also here, the correlation was not as strong as it used to be. So we're getting close to, we're at the 140 handle. 141.70 still works as resistance. 140 is support. We haven't gone too far. We're a bit lower today. Another thing we had yesterday regarding oil is the crude oil inventories. They went up, but distillates went down. So it's more or less a mixed picture over there. The Fed did little. Okay, Aussie dollar, 70.66, continuing to break ground, moving a bit higher. The pair is a bit choppier than it used to be, but 70 emerges as stronger support. Real resistance, I see it only at 71.50, but we might see resistance emerging here at 70.80. Okay, let's talk about and the New Zealand dollar. We had the rate decision in New Zealand right after the Fed, and the New Zealand rate decision was more interesting than the Fed. This tells us how boring the Fed was. But let's talk about the positive side. The New Zealand rate decision, no change in rates. They said they would not move probably last time when they did cut the rates, but we heard a few things from them. We heard from the central bank in New Zealand, the RBNZ, Graham Wheeler is the governor, that they expect further depreciation of the Kiwi dollar. That's dovish. And the second thing is that they opened the door to more easing in 2016, this year. They said that that more easing may be needed or something like that. Anyway, it was much clearer than the Fed's words, and it hit the Kiwi. We've seen the pair fall up all the way up to here. This would be better support, 64.17, below the previous support line at 64.25. Now we're seeing some kind of a recovery this morning. The mood is a bit better in general this morning, but the Kiwi was hit. It fell within the range to lower ground. It's not the Fed's risk-off mood. It's more the central bank in New Zealand going dovish, hitting the Kiwi. Okay, so there we have a clear reaction. Let's also look at what other things we had yesterday. It was not, I'm complaining a lot about the Fed, but we did have other figures. So in the United States, we had new home sales beating expectations, coming out above 500,000. This joins other good housing figures. The HPI in the United States, the Case-Shiller Home Price Index, rose 5.8% in year over year. I think that was the figure for December, so it's for the full year. Existing home sales that we heard about that back on Monday, they were better than expected. New home sales were better than expected, so we had some good news over there. We talked about oil inventories were positive. RBNZ was dovish. Contrary to the dovish RBNZ, the other figure from New Zealand, trade balance, it beat with a very small deficit, but of course the central bank has more impact. In Japan, retail sales missed by dropping 1.1%. We have a rate decision in Japan tonight, but we had a more mixed picture from the Australian import prices, just falling 0.3. Also supporting a stronger Aussie. This goes hand in hand with the better than expected CPI figures that we had from Australia earlier. But in the old continent here, we had German import prices miss, falling more than expected. So these are the figures today. We have now Spanish unemployment rate actually was released. Let's look at the calendar. This is the FX Street calendar on Forex Crunch. Okay, another fall in the Spanish unemployment rate. Good news, but we're still at sky-high levels. Okay, 20.9% unemployment rate. That's still high, better than 21.05 that was expected, but I can't say it looks good. And retail sales missed here in Spain. Anyway, some figures here from the old continent. Let's talk about a few more charts before we move to today's other events. So we talked about all the pairs, all the major ones. The Swiss franc maintains its weakness, pushed perhaps a bit from the Swiss National Bank. We heard one of the SNB members talk again about the negative interest rate being a pillar of the Swiss policy, and the second pillar being a weak currency. Okay, they're not afraid to say they're intervening. We're seeing another move higher in Euro Swiss. Remember, we had the pair at the 108 handle for a very long time. Then we began moving here to higher ground between 109 and 110. A break above 110. I suspect there was intervention here from the Swiss National Bank, and we reached a new high of 110.75. Perhaps that's another high. I don't like this pair at all. I don't like Swiss franc pairs at all. Just important to note that I don't like it because of intervention. Okay, nothing seen. If you can't see the video, please refresh. Let me write that down also. If you cannot see the video. Okay, so we have the Swiss franc finding a new high level. If you're brave enough to trade levels, we can see that the pair does trade in ranges, but because of so much intervention, I would stay away. Euro pound, let's see what's going on here. Establishes itself in a range. Let's mark it. Okay, so we have 75.50 here, and I would say 76 to the upside. Quite a nice range. We had the pair reach very strong resistance at 77.40, which was an old support line when the pair traded on higher ground. Okay, and now we're on lower levels because the euro is a bit stuck and the pound did manage to recover just a bit. Euro yen, the safe haven pair, moved out of range finally. It's because of the weakness of the yen. Less safe haven flows. 129.23, still under 130, but we had it range trading between 127 and 129. Pound yen also on a recovery move, capped by the round number of 170. Very, very volatile pair. Okay. Support, maybe this would be better. Yeah, it's become a bit messy, this chart. Sorry. 168.60 to 170, I would say, is the current range in the dragon, the gepi, whatever you want to call it. Okay. Comment here, I'm with you on that. Swiss pairs, you're playing poker with the dealer. Yeah, the dealer is Thomas Jordan, the governor of the Swiss National Bank. One more thing here about the chances of the next rate hike from the Fed coming in March. Yesterday it was around 70%, now it's around 75%. So also in bond markets, the decision by the Fed is perceived as dovish, not extremely dovish. It's not off the charts. They don't rule it out. Also, in a survey done by Reuters for primary dealers, those institutions actually dealing with the Fed, they still see 3 rate hikes this year, which is more than we expect from according to bond markets. Okay, let's continue with today's events. Okay, so we talked about the Spanish unemployment rate, which was released at 1 GMT. We have German inflation data. Now it's important to remember this is preliminary data for the month of January, for just now. The month didn't even end, and Germany already releases some numbers. And the data is initially released from the various German states. Okay, so the final number is at 1 GMT, but we have preliminary releases from different states. There are 16 German states. The first one is Saxony. We already have that number out. So it's a drop of 0.9% year over year. Sorry, month over month, minus 0.9 month over month. And year over year, it's actually higher. It's actually 0.4 year over year. And it was last time it was 0.2. But we also have the so it's a bit mixed. Remember that last year in January, oil prices were much lower than in December. What does that mean? That we're going to begin seeing the removal of base effects, what they call base effects in oil prices. We had that, let's talk a bit about that. The big fall in oil prices came in November. I mean, the peak was in June to August 2014, and then we had it slide down. In November, we had OPEC deciding not to cut. Not a huge surprise, but that sent oil plunging down. The plunge continued, and oil prices found sort of a base around January. Since then, it went a bit up, and then it resumed its falls later on. Okay. Now we've already seen in the United States oil prices react much quicker than in Europe. We've already seen that for this headline CPI in the United States, inflation went up, okay? From around 0, it's already 0.7. Of course, in the United States, they focus on core inflation. In Europe, the ECB focuses on headline inflation, which includes oil prices. Now that we have the preliminary figures for January, we're expecting to see some kind of rise in inflation, in year-over-year inflation, because in January last year, oil prices were very low. They're also low now, that's true, but the percentage of the fall is not that severe like it used to be between December 2014 and December 2015, or between August 2014 and August 2015, okay? So we might see higher inflation in Germany, but it's not unexpected, okay? Anyway, German inflation data, which is released today, with the final figure at 1 GMT, feeds into the all-European figure, which is released tomorrow. And Germany is, of course, the largest and most influential country. So that perhaps, hopefully, could impact the euro. But we have the releases throughout the morning. That's why I mentioned it already at the beginning. At 9:30 GMT, well, just in an hour from now, more or less, we have UK GDP, the preliminary release for the fourth quarter in the United Kingdom. It's a very important release. We're expecting a small rise, a small acceleration in growth from 0.4, the final figure for Q3, to 0.5 in Q4. Year over year, we're actually expecting a slowdown. So instead of 2.1, we're expecting 1.9. That's actually the whole growth rate for 2015. I suspect it could be a bit lower. We had a few warnings from the government about a cocktail of threats. We had PMIs not looking that good. The first release has the biggest impact in the UK because the next releases do not change the picture much. This is different than than in the United States, where every revision is a roller coaster. In the United Kingdom, in general, the figures come out more closer to expectations, and then the revisions do not change too much. For instance, in Q3, we had eventually downwards revision from 0.5 to 0.4. Yes, it was revised, but not a huge number, okay? Anyway, this is a very important event for the pound. The levels to watch in the pound are, but perhaps currently 142.72, currently at the top of today's narrow range. 143.60 if we have a beat is high resistance, 141.25 if we have a miss. Remember that in the UK, we often see data leaked out, okay? Leaked out, or markets just deciding to front run the publication, all right? So we might see a move. Let's say we see a move to the upside and eventually we have a better than expected figure, okay? This does not mean we'll see an extension of the rise. We might see a buy the rumor, sell the fact, or buy the leak, sell the fact. And the other side works as well. If we have the pound falling towards the release, and then we have a worse than expected figure, we might see the pound rise, despite this fact, because it's already priced in. Movements usually occur in the 15 minutes and preceding the publication. Okay, so it might be a tricky one. Of course, it depends on the magnitude as well. For instance, if we'll have 0.8 growth, it's a huge beat, and then even if we have the pound rising towards that, we might see it extending the gains. And if we have 0 growth, for example, we could see the pound extend its falls if it falls beforehand. But if we have a small beat or a small miss, it could already be priced in because of a leak or because of front running. Okay, a question here. Couldn't you just erase all your levels and just throw a dart to trade GDP? It could be really a wild reaction. There's pound in general moves quite a bit, which is an opportunity and also a risk, especially against the yen. And it's different than the euro, which is a bit stuck. Okay, so at 1:30 GMT, we have an important set of releases actually from the United States. Durable goods orders at 1:30 GMT. Right here. Actually, we have a few releases. So headline figure is expected to fall 0.6%, but it's always impacted by sales of airplanes and things like that. So it's not always the most important thing to watch. The core figure, the ex-transportation one, is more important. We're expecting another fall of 0.1. Things that are durable, that means that they last at least 3 years. This also reflects investment. Okay, so this is an important figure to watch. It's the figure for December, so you can say maybe it's a bit lagging, but I think it's still of high importance. The Fed looks at it quite closely. We also have, because it's Thursday, the weekly jobless claims. Last time we had it disappointing, rising to 293. We had long months of drops in jobless claims. Good news, less people out of jobs. But in the past few weeks, we're seeing this not so good trend to the upside. Now we're expecting a small drop, 282,000. The correlation between jobless claims and the NFP is not always clear, but it's another job figure to watch. And the Fed has 2 mandates, employment and inflation. Okay, at 3 GMT, we have pending home sales expected to rise 0.8. Out of all the housing figures, this is the least important one. So I expect, in terms of US figures today, most important one is core durable goods orders, then jobless claims, and then pending home sales. Okay. And for those of you staying up at night or waking up early in the morning, we have a warm-up with Japanese inflation data at 11:30 GMT. This might have a small impact, but Bank of Japan probably already has it. It might give us some kind of hint about what the Bank of Japan can do. But the Bank of Japan doesn't only look at these official figures, it has its own ones from the University of Tokyo and things like that. And it's also complicated Japanese inflation figures, as you can see, lots of data here. We have the national ones, which are for December, and the Tokyo ones, which are for January. So the ones from Tokyo, the capital, are more important. Anyway, more important stuff. I've also from Australia, private sector credit and producer price index, not as important. The big event for the night is the Japanese rate decision. Okay, it wasn't supposed to be an important decision. The Bank of Japan had the semi-annual forecasts back in October and decided not to act. There was some thought that they would act. All in all, they were pleased with the direction of inflation, even though they're not hitting their target. And the yen was more or less stable. It's still quite stable, around 120 it was at the time. So everybody thought, okay, the next opportunity for the Bank of Japan to act would be the next semi-annual decision in April. It's going to be boring anyway. forget about it. But last week we had a change. Last week, dollar yen fell under 116, and suddenly we heard from the Bank of Japan, we are closely monitoring moves in currency markets. Then we had also the Japanese government. Prime Minister Shinzo Abe said, perhaps it's a good time for the Bank of Japan to act. In Japan, there's more intervention, more influence from the government to the central bank. Since then, of course, the yen reacted negatively to all this talk. The yen weakened. Also, the mood improved in markets. Of course, when the Bank of Japan is ready to act, when the ECB is ready to act, and when the Fed also, there were expectations that it would go more dovish, the mood in markets improved. Okay, the yen weakened. It went from 116 dollar yen, rose to current levels between 118 to 119, and this sort of lowered the chances for action from the Bank of Japan. Okay, but there's still a risk that they will act. First of all, they did talk about these things, about what monitoring currency markets. The government did talk about action. And with the current level of oil prices, Japan can afford itself a weaker yen. When Japan imports a lot of oil because of the Fukushima disaster, we're nearing 5 years to that tragedy, the tsunami, earthquake, and disaster at Fukushima. And Japan closed all or almost all its nuclear reactors, okay? So it became more dependent on imported oil. When oil prices were high, this meant a higher trade deficit and a bigger burden for the Japanese economy. But, well, since then, oil prices fell quite a lot, and these imports are much cheaper, okay? There's just too much oil sloshing around the world. So Japan can afford itself not only 120, but perhaps 125 or 130 in oil prices, which are denominated in US dollars. So perhaps they will act, perhaps they will hint about action. Opinions are quite mixed about that. I think that in any case, we'll have market reaction. If they don't act at all, we'll have a strengthening of the Japanese yen. If they hint about perhaps action in April, watching closely or making small tweaks like they did in the past, we could see the yen weaken just a bit. And if they announce new QE, new bond buying, or perhaps negative rates, like in Europe, like in Switzerland, like in the Eurozone and like in Switzerland, we could have perhaps a much bigger reaction from the Japanese yen. So everything is open there. It would also mark a new, if they do act, of course the chances are mixed, but if they do act, it could also mark another step in the currency wars. We could see more action from China. We could see higher chances of ECB action. So I think it's, the Bank of Japan meets 14 times a year, okay? More than once a month on average. And usually these events are non-events. This time it's a bit different, okay? So lots of events today. Europe, the UK, the US, and Japan are all important. Let's see if I didn't miss any event on the calendar. Talked about the Australian figures. They shouldn't move markets too much because we already had CPI from Australia, which came out better than expected, and it's a quarterly release, and it's more important. Okay, let's look at the chart, see what's going on today. Usually during the show, we have markets waking up. Well, it's called the market open, and we have some action, okay? At least some kind of movements today, not too much. Euro dollar more or less in the same place. Same, well, dollar yen is moving a bit higher. So we could call that a risk on atmosphere. Pound dollar also a bit higher, which is also risk. Dollar CAD falling, risk. Yeah, so better mood this morning in markets with stronger commodity currencies, stronger pound. Euro is not doing too much, but the yen is a bit weaker. These moves are not huge. Also, the Kiwi that was hit hard by the central bank yesterday is recovering. Okay, any questions? We can talk about more events this week, more charts. Let's see if we have more data from Germany. Not that I see. What's your bias on euro dollar after the Fed? My bias is frustration. Look at the euro dollar chart. It's stuck in range. It's hardly moving anywhere. I think that after the Fed basically managed to do quite a nice balancing act. It lowered the chances of a rate hike in March without committing to anything. I think we'll see more frustrating range. If we have some big news from Germany today regarding inflation, if we have strong inflation numbers, it could strengthen the euro. If we have weak inflation numbers, it could weaken the euro. The more important inflation releases tomorrow from the whole eurozone, so that could be more important than the Fed. The Fed did not manage to rock the boat in euro dollar too much, did not manage to rock the boat in basically any currency, so it weakened the dollar just a bit. No, but usually we have an initial reaction at the release at 7 GMT. Then at the Tokyo opening, we have another reaction, and then in the European morning, a third one. This time we had very little movement. Perhaps we'll have another reaction in the US session, but then it could also be correlated to the new figures that we have from core durable goods orders. And my best takeaway from the Fed perhaps would be that they told us that growth slowed at the end of 2015. That means that the GDP released tomorrow from the US is going to be poor. Okay, not below zero. They said slow growth, not negative one, but, or, I mean, they did say growth, the word growth. So that could give us a hint. Do join us once again. We're going to be, I think, the same composition. Valeria, Dale, Mauricio, and myself tomorrow, I think from 1 GMT, half an hour before the release. All the data, of course, will be published on FX Read, and it's going to be interesting as well. So my bias, I still think in general that there's more room to the downside in euro dollar because there is still more action coming from the ECB, and I mean action to weigh down the euro, and the Fed could still hike in March if we have good figures. But look at the charts. Let me show you the charts once again. It's quite ugly. It's quite choppy. It's not the most interesting pair to trade at the moment. This could, of course, change. Usually when we have these periods of consolidation, they result in an explosion. It was much more interesting in December with this big fall, and then boom, it shot higher. Since then, well, we're seeing it grind a bit lower, but it's a grind. It's not a real movement. Any more questions? Anyway, we're currently in the higher end of the grind lower, so it's, look at this frustrating range, less than 40 pips. And look at pound yen, for example. Look at this excitement. Just today, 100 pips on a slow day, and we had very exciting days beforehand. And we talked in the past about other crosses such as, where did that go? Euro, Aussie, for example. Lots of movements over there, and more predictable lines as well. Look at this very nice support line here, 153.40 and 160.40, for example, or Euro CAD. I know some of you asked about that in the past. Look at this nice support line here, or yeah, not perfect, but it looks more interesting. Another question: what could be the impact on euro dollar of a poor US GDP? Will still be balanced by expectations from ECB in March. Will it pop on the upside? I'm also looking for that pop in the euro dollar to the upside or to the downside. Poor US GDP, I think, is partially priced in after the Fed. If we have a negative one, I'm not sure it'll be positive euro dollar. Sorry, I'm not. Yeah, no, it should be positive. Sorry. A poor US GDP tomorrow. We'll talk about that tomorrow more in detail, of course, but will be more positive for euro dollar because it implies two things. First, lower chance of Fed action. That means the weaker US dollar across the board, and also risk off because the US economy cannot lead the world forward, and that's also good for the safe haven euro. Okay, if we'll have a positive US GDP, it'll be of course good for the dollar. Okay, any more questions? Or maybe do a small recap of events of the week. Comment here from Egg. Pound Aussie better than Euro Aussie. Get good range days. Okay, let's take a look at that one. Did I miss here? Haha, here we go. Yeah, we're seeing a nice trend to the downside, and we're nearing support, right? On this pair. Looks like interesting over there at Pound Aussie 201.70 is support right now. As we speak, we've seen a dip below this level. 205.30 is resistance. Yeah, quite an interesting pair. A bit choppy, but there are much choppier pairs to trade. And this one does seem to have interesting lines. So thanks for pointing that out. Yeah, I got that. That was Euro Aussie, not Euro UAE. AUE, anyway. So yeah, Pound Aussie is interesting. Both of them are currently risk currencies, but they do not move in tandem. Okay, when Carney hit the pound hard, the pound of course crashed also against the Australian dollar, and when China went rogue, it hurt the Aussie more than the pound. So we do have quite a lot of action here. Quite a nice pair. Yeah. Okay, let's do a small recap of the events we had so far this week. Tomorrow, as usual, every Friday, we'll have a preview of next week's events. And I'll just mention that I will not be here on Monday, taking a long weekend, but I'll be here back on Tuesday. Tomorrow, of course, there's a show as usual. So this week on Monday, we had German IFO business climate that came out worse than expected. Draghi didn't say anything. Carney repeated what he said, which was quite dovish. It is not the right time to raise rates. Consumer confidence in the US was better than expected. One of quite a few positive figures in the United States. Better than expected CPI in Australia. Mixed oil inventories. The Fed, as we mentioned quite a few times, it was not a one and done. It was relatively dovish, but quite balanced. RBNZ was clearly dovish. They hit the pound. That was a nice move from Wheeler and his colleagues. Today we have GDP in the United Kingdom, durables goods orders, and I would perhaps add German inflation could also be of importance. And tomorrow it's a busy day. Not only the things we mentioned, Bank of Japan, US GDP, and also Canadian GDP could divert the attention from for the Canadian dollar from oil prices for a change. Okay. 812 hourly chart, no problem. Let's take a look at the hourly chart of Pound Aussie, right? Oh, why don't I have an hourly chart here? And let's see if I can. Let's see, 480 minutes is 8 hours, right? Yeah, thank you very much for pointing that out. This looks much clearer than the hourly chart. We can see here nice lines of support and resistance. So you can take a look at this one. Perhaps a better line here is, 201.70. We're just above this line, and it works nicely as support. Let's look at further support for this pair on the 8-hour chart. Yeah, right here at 196. All in all, this pair is not too shabby, this cross. I know lots of you are focusing on euro dollar. It's the world's most popular currency pair. It has an impact on many people's lives, not only on currency traders, but it's not always the best pair to trade because it has much more frustrating ranges. So if we take the same 8-hour time frame on euro dollar, we can see that since December 3rd, that ECB decision, the moves are not huge, especially in recent weeks. Question here, euro dollar will rise today on inflation data. I don't know. It depends on the data. If we have really strong data from Germany, it could be positive, but perhaps not so much because this pair is very, very frustrating. Okay, what's happening to euro dollar spiking up right now? Let's go back to the hourly chart so we can identify the spike. I don't have any news that I've seen coming out apart from that figure from Saxonia, however it's pronounced in German, which inflation there was actually, it wasn't that huge. Sorry, year-over-year inflation in Saxony is plus 0.4 against plus 0.2. So that could be attributed to a stronger euro dollar, but I would say that we're seeing a spike of 25 pips. We're still within the range. It's a 40 pip range. We're not moving anywhere fast. Hopefully, we'll either have a spike to the upside challenging 110 or a spike to the downside challenging 107.80. Okay, we have news from Japan. Economy Minister Amari steps down after delivering his side on the bribery scandal. So there are allegations there of corruption in Japan. They do tend to quit when there are allegations. Here in Spain, the verb to resign is dimitir. Okay, and there's a joke, dimitir, it isn't a Russian name, it's also a verb. Anyway, the joke goes that, well, Spanish politicians do not quit so fast. Anyway, before the US GDP announcement, will euro dollar touch the high of 110? I don't know, it depends on many things today and tomorrow. First of all, the inflation figures in Germany, durables goods orders in the UK, jobless claims, and the mood in markets in general. 110 would be hard to reach, but it's possible. German inflation data is released from the different German states as we speak. So I only have the figures for Saxony so far, one of the German states. The final figure is at 1 GMT. Okay? Yeah. So it's time for the wrap-up for today. This is the wrap-up for the live market open for Thursday, January 28th. Yesterday we had the Fed decision, which was very, very balanced, but slightly dovish. They talked about growth slowing late in 2015. They still put a big emphasis on inflation like in December. They did remove the reference to balanced risks, which is something that raised a few eyebrows and also got people a bit worried. And they are monitoring global and financial developments. That means China and stock markets. And despite a new composition of the voting members in the Fed, more hawkish, the decision, which was a bit dovish, was unanimous. So that's another dovish move. But we saw very, very few movements. What else did we have yesterday? Okay. We had a few other events. Actually had a good figure from the United States in new home sales. Oil inventories were quite mixed, with crude up but distillates down. The RBNZ, the central bank in New Zealand, did deliver. They delivered a dovish move. They opened the door for rate cuts in 2016, saying further accommodation may be warranted. And they want a weaker Kiwi dollar. So that was dovish. And they hit the Kiwi dollar. More figures, import prices in Australia fell less than expected, but in Germany they fell more than expected. Okay, let's look at events for today. The Spanish unemployment rate came out better than expected, but it's still sky high, 20.9%. I hope people here around me find more jobs. Anyway, these jobs aren't paying that well. German inflation data, we have releases from the various German states. So far I have figures only from Saxony, which showed stronger year over year, but remember it's also the effect of oil prices. The final figure is at 1 GMT. Just after the show, in around 45 minutes, we have the UK GDP release expected to show 0.5% quarter over quarter, a bit higher than the previous one. Let's see if it moves the pound. Well, the pound moves quite a lot. Remember, there are leaks and there is front running by markets in UK releases, so it could be quite messy. At 1:30 GMT, durables goods orders. More important, the focus there is on the core figure, more important than the headline figure. At the same time, we have the weekly jobless claims that worryingly went a bit high in recent weeks, and let's see if it manages to slide back down from 290 something thousand to the 280 range. Pending home sales also in the United States at 3 GMT. A few inflation figures from Japan at the beginning of the night, but the big event is closer to the European morning, the Japanese rate decision. Last week we had hints from the Bank of Japan that they're ready to act, that they don't like the the strength of the Japanese yen. We heard from the government, but since then the Japanese yen did weaken a bit. So everything is possible. It's really an open decision. I expect action in Japan in the Japanese yen, regardless. Well, not regardless, but in any case, if they do act, of course, it'll weaken the yen. If they act a bit, it's going to be messy. And if they don't do anything, the yen is about to strengthen. Okay, let's look at a few charts this morning. Euro dollar moving just a bit, but very, very limited in range. 40 pip range 109, resistance 109.50, 110, 110.70, support 107.80 and 107.10. Okay, dollar yen, the other safe haven, 118.80, capped here by 119, 119.05. Further support, I would say 118. Okay, waiting for the Bank of Japan in general. Pound dollar waiting the GDP release. Currently, well, just a bit up in the range. 143.65 and 141.25 are the levels to watch. I think we'll have nice action here. I hope the pound usually does deliver action. Dollar CAD, the Canadian dollar continues improving on higher oil prices. Tomorrow we have GDP from Canada. 140 is the round level to watch. 141.70 and 143.10 are on the upside. 138 on the downside. Okay, quite significant movements on dollar CAD. A pair certainly worth watching because of oil prices, because of really nice moves here. The Australian dollar 70.77 at the moment. 71.50 is resistance. We're seeing an uptrend here on the Australian dollar. Better than expected CPI stability from China helps the Aussie. Soon we're going to have the Chinese New Year in China, of course, and then we might have more focus on Australian figures. No rate cut is expected from the RBA next week. Kiwi dollar recovering in range, but was hit hard by the Central Bank of New Zealand to 64.17, 64.18. Anyway, or 64 even. Anyway, 65.80 is resistance and 63.10 is support. Okay, so I think we have, despite the disappointing Fed, we did have other things moving markets. Today is expected to be a busy day on all fronts: Europe, UK, United States, and finally Japan. So I guess that's it for today. I wish everybody a safe and successful day. Euro dollar hopefully will break out of range, but remember, it's not the only currency pair out there. Thank you very much for all the questions. And that's it for today. See you tomorrow. Thank you and bye-bye.